Okay, in this chapter, we kind of bring together our discussion of interest rates to look a little bit more broadly at how they're determined. Now, right before this class, um, you probably would just be led to think, well, the Federal Reserve, because the Federal Reserve, the central bank in the United States, controls the money supply, the amount of money supply, then it's the Federal Reserve that determines the interest rate, um, which makes it a lot more top down than it really is. It makes it a bit more, it makes it seem a bit more authoritative than it really is. And so, if anything, in this lecture, the goal for this lecture will be that when you hear on the news the Federal Reserve lowered the interest rate, that you'll get as frustrated as I do, because it's just not true that the Federal Reserve has that kind of control. Yeah, but we'll do some other things too. Um, okay, this slide actually is not accurate. Oh, those are the days. So here we make this lecture here on April the 25th, 2024. Just 4 years ago, um, we had this discussion where interest rates were so low. And I mean, there's no harm here in looking at the data here. So let's just go to Fred. And I don't know. Sure, I'll just, no, I won't do that. Looking at this again, and I know we've looked at this just in the previous chapter here, but right, when that slide was made, it was made right here around mid 2020, so that would have been right around here. Right, and the narrative is that the Federal Reserve, in an attempt to stop economic consequences from coming from the pandemic, lowered interest rates in an unprecedented intermeeting move, meaning that here in January of 2020, we were at what 1.5% federal funds target rate, and there was no expectation that it was going to be going down. In fact, the discussion was that it likely would be right either stable or even some tendency to be going up. And instead, we see that by end of March, we're down to zero. And we stayed at zero through 2022, causing in part a housing boom, causing in part supply chain problems as individuals could find it inexpensive to stock their house, to rebuild their house, to expand a business, buy a car. Interest rates were really, really cheap. And now, right, well, then 2022, because of, the narrative was that because of the supply chain problems that we needed to slow the economy down and raise interest rates. And this was done quite dramatically. So if we look at this, right, from February of 2022 here, where it's at zero, to, I don't know, right, we could see here then, about a year and a half later, that's at 5%. Very difficult for an economy our size to adjust that quickly to a 5% interest rate, whereas previously it was basically zero. And that's kind of the problems we experienced through 2023 with the banking crisis in March of 2023. And we kind of still face it somewhat today as well when we think about the housing market and whatnot. So, when you hear that narrative on TV that says the Federal Reserve changed the interest rate, in some sense, this graph would be what they're looking at. And don't get me wrong, it's really important, this federal funds rate. So let's just talk about what that federal funds rate is. That federal funds rate represents the Federal Reserve is it sets a target for what it would like the federal funds rate to be. It doesn't determine the federal funds rate. And what the federal funds rate reflects is the interest rate that banks charge each other for an overnight loan. If you think about that description, that would seem to be a largely risk-free transaction because you've got banks lending to other banks, and additionally, they're only lending to the bank for one single night. So what could go bad? Well, we know what could go bad, right? If I extend this out further here, we can see that you could get some big problems here in the financial crisis, right, where interest rates were going up, and then banks could actually fail, right? And then you get banks that don't want to lend to each other. But this is actually just kind of a nice picture to look at here. It gives us this kind of narrative of what the landscape looks like for general interest rates, where again, interest rates are sort of used as the primary tool at which to make adjustments to the economy through monetary policy. As an economist, most economists, myself included, tend to believe that monetary policy is preferred to fiscal policy in general. Not really. It's just that it's a bit faster, it's a bit more precise, it's a bit more lasting than fiscal policy, meaning that the government using spending and taxation to adjust the economy. Quite typically, though, failures in the economy, like the inflation that we experienced in 2021, 2022, I would place blame on the Federal Reserve. Others don't. Others think it was the pandemic and that it was supply chain problems and whatnot. But as I discussed again in the last chapter, you really only have to look at how the money supply was changing to see why inflation was occurring. Look at that change from 2020 onwards. That rate of change is much higher than it was throughout most of this history here. And it should be noted that banks really aren't. Now, this is discontinued, so it doesn't take us too far here. It only takes us through 2021. But banks, remember back when you learned how banks make loans and they help create money? Quite frankly, that just doesn't. Sorry, I'm looking at the interest rate on excess reserves. I wanted to actually look at the amount of excess reserves. Banks are just holding lots of extra cash. So banks are sitting on the sideline, and they have been sitting on the sideline since the financial crisis. This is what causes some problems for the Federal Reserve. Because if you remember that equation, right? I'm going to find the pen here. If you remember that equation, is that the money multiplier equaled 1 over the required reserve ratio times the change, how much the Federal Reserve changed it by. Well, the required reserve ratio it changes by size of bank, but let's just say that it's 10%. That would mean that, right, what the Federal Reserve changes it by, let's say it changes it by 100, then the total change would be 1,000. So the thing is that the Federal Reserve knows, or thinks it knows, what total change it needs. And it's probably not going to change the required reserve ratio. but it's not getting 1,000 for $100 change because banks are holding excess reserves, which then limits this, makes this less than 1,000. But also here you see that it's a bit unpredictable. Not sure here if we can see here. I mean, look at that. Is this as far back as it goes? Yeah, it is. Of course it would be. So it looks like it started to be tracked here after Federal Reserve officials realized after the financial crisis that this was starting to happen. So it looks like the data starts in 2010. And then you might then say to yourself, well, why did they stop counting it in 2020? Well, it was actually replaced here. I have to see here what it was replaced by. There was something, I guess I could look at the announcement, but yeah, it is replaced. So you can get the data. It's just a little bit clunkier. Don't ask me. It's not that I agree with it, but that's the way it was. Okay, well, okay, that's a lot of discussion here of a slide that didn't mean anything here. But what I'm trying to do again here is trying to motivate the discussion of what we're trying to look at here. That interest rates aren't just determined by the Federal Reserve, but as this last bullet point highlights here, that interest rates are largely determined by the much broader bond market, which gets a lot less discussion compared to the stock market. Okay, so let's kind of skip over this here. So let's look at some issues that arise when we're looking at portfolio choice. So when we're talking about portfolio choice, we're talking about why do people hold the investments that they do. You know, the typical portfolio, if you were to ask someone like my wife who deals with this on a daily basis, is that any client that would come into her office, unless they were really old or really young, would probably just get a pretty simple portfolio. And that portfolio not that you need me to write it out here, but that pretty simple portfolio was a 60-40 portfolio. 60% stocks, 40% bonds. Now, what did I say there? Unless the person was really old or really young. Because if the person is pretty young, then they've got a long time to invest. They don't have a lot of wealth. And they're probably individuals that are willing to take on much more risk. So the idea that they would want to hold, and I should add here, they are actively working, so liquidity needs are less. The liquidity needs are less because, right, they're getting a paycheck on a regular basis. So they don't need to worry about quickly turning things into cash because they have cash regularly coming in, right, every 2 weeks when they get paid. As opposed to someone very old, right, where the wealth is higher. There's some preference here for preserving wealth, right? They want to know how much they have because they have to spread it out over a 20 to 30 year time period where they're not going to be getting a regular income. They would like to keep some fair degree of liquidity because things can happen where they do need to withdraw a certain amount, right? Unexpected illness, death coming, kids need, right? Their kids need a down payment for the house they're building, that kind of stuff. So with these two groups here, these two groups would be the young would be a bit more equity oriented, the old would be a bit more bond oriented, but it just really changes from this 60-40 mix. 60% of the portfolio in stocks, 40% in bonds. Based on these considerations. Now, the industry, the financial industry, tries to simplify this by creating what are called target date funds, which if you have a 401k, let's say you're working, these things are usually your default. If you ask me personally, I don't invest in them. I think they're pretty junky. And the reason why I think that they're junky is, let me just give you a simple example here. Vanguard is one of the largest fund families out there. And so what they're doing probably, dictates a lot of what others are doing. But there's a reason why I want to show you this here. And so, I mean, you can kind of see this with this chart, and this is kind of the first time I'm looking at it, but you get the idea here, right? When you're young, you're much higher in stocks, right? These green regions representing stocks. And then as you get older, you get more bonds. But then in general, again, you kind of see this 60-40 mix for the most part for individuals. But you see here how it should basically be a little bit different based on whether you're really young or really old. But I want to find just the thing to show you here. These are mutual funds. And I want to look at target date funds. Don't worry, I'm going somewhere with this. You might not think I am, but I am. There we go. Let's just take something like this. So let's say that I'm pretty old. I'm old, but I'm not that old. But let's just say I was planning to retire in 2025. So I go to my financial advisor and I say, I want to retire in 2025, 1 year from now. Okay. So, right, in terms of that 60-40 mix, I should have a lot more bonds, not as much stock, because I'm getting ready in less than a year to be retiring. That's what we should see. More bonds, less stock. Let's click on it and see what we see. So, right, this company then, Vanguard, would invest the money such that it's expecting that I'm going to be retiring in 2025. Well, if we look at what it's investing here, that in 2025, it looks to have put 32%, 21%, and that's okay. Let's just give them the benefit of the doubt. 32%, 21%. I'm going to write down these numbers here. 32, 21. And then Admiral Fund shares for these tips that would count as stock. Okay, so 53. And then let's just call it 47. So it'd be at 47% stock, sorry, 53% stock, 47% bond. Sorry, I can't really draw on this. Sorry. Okay. Now, if you were my client, and I'm not an advisor, if you were to come to me and say, should a person who's just about to retire still be 53% invested in stock and 47% invested in bonds, I'd say, well, it actually depends, right? What if I'm retiring because I'm really, really sick? Well, then I shouldn't be 53% even in stock. I should be a lot less. Additionally, international for both bonds and stocks tend to underperform the domestic market. So, do you see what I'm saying here? Is that these kind of one investment fits all people who are investing in 2025 doesn't really work. And additionally, I don't think I would tell anyone who's planning to retire in a year, let's say, I guess what would my retirement year be? 3, 23, I don't know, let's say 2040. I don't think I'm retiring in 2040, but that me being in 2040, that I should be almost 80% invested in stock. Dude, I'm not 80% invested in stock. That's really risky, even though I do have a fairly large amount of time still working. And I do obviously then need the growth, but that's really high in stock. Really high. Huh. Why do you say that, Scheiding? Well, look at this, right? People are different. People have different risk portfolios of what they're willing to accept. I'm a little bit risk averse. I don't really want, I mean, I understand things well enough to be scared of things. And I don't think I'd want 80% of my portfolio to be in stocks. So I'm different. Maybe I shouldn't be in this target date fund. In essence, that's what an advisor would do. Would take into account these five different things and try then to allocate your money into equities and bonds. And they would do that for all of their clients. So, what is wealth? Well, so what we're doing now is looking at each of these factors. This one should be pretty easy. Wealth would be basically my accumulation of assets over time minus your liabilities, what you owe to others. So, for instance, I have assets, but I don't have really much net wealth because my liabilities are also pretty high. I owe a pretty big mortgage on a house and whatnot. And so, I don't know, probably at around zero. At least I'm not negative, but I'm at probably around zero. So, what does that mean? It could go one or two ways depending on my risk levels, but because I don't have a lot of wealth, but I do have a regular income, I probably, just based on this factor alone, would probably be more willing to take on risk and invest in equities because I don't have a lot of wealth and I need to build that wealth up over time. So I need to take more risk to build more wealth. Then you've got your expected rate of return. Now, in some sense, this reflects what you expect the stock market or the bond market, how you expect it to perform over time. This is quite inexact science. This would be the equivalent of trying to predict the weather. Not very easy to do. I'm not trying to make this a lecture where I just talk about my wife the whole time here, but I'd probably say at least a few times a year, my wife asks me about my predictions about interest rate projections over the year. And I couldn't even, I don't think I'd be very good at predicting how they're going to change. Even economists themselves are pretty bad at it. Federal Reserve gives us a scatter plot. And don't think, yeah. So here you go. This one's from March 20th of 24. So this would be individuals who are on the FOMC. So that's 12 people. That's the 7 members of the Federal Reserve Board, and then 5 district banks, of which New York is always included. So you should have 12 plots here. I'm not going to count these all out here. But you should have, right, this is people plotting what it should be. So you would see here a pretty wide variance that some individual here thought is going to be around, some individual thinks it's going to be around 2.5% next year. Another individual thinks it's almost going to be 3% higher than that. Even here, you tend to see right, a bit more agreement or some consensus that it's going to be a little bit lower than it currently is, I'm not sure that we're going to see that. So the more widely dispersed the dots are, the more disagreement there is among the Federal Reserve about what they think the rates are going to be. Um, this actually looks like a pretty good article. I mean, it's from Bankrate. Um, I'll make a PDF of this and post this to Canvas just because it would give you a pretty good description of this if this is something that interests you. Okay, but going back here to the expected rate of return, um, this would then obviously your predictions about what the expected rate of return would then influence whether you invest in stocks or bonds. With the idea that you're always seeking the highest expected rate of return. The only thing that kind of makes this problematic would be from this slide here would be that and that. Pretty difficult to say. This example here is highly unrealistic that you have a 50-50 chance of either a 15% rate of return or a 5% rate of return. Gosh, that's really unlikely. But if that were the case, you would simply take those probabilities reflected as a decimal and multiply it by the rates of return. Okay. Risk, this one should be a bit obvious that the greater risk that an individual wants to take on, the more likely they'd be invested in equities. The more risk averse they would be, they should be a bit more invested in treasuries, really safe government bonds. And risk neutral would be is that they don't even look at risk. That seems really odd and really. I guess you could be. No, it'd be very odd. And so, generally, what we see, the simplest explanation of why do Treasury bonds, U.S. government debt, have such low interest rates, and that would be because the rate to return, the risk taken on is so low. Whereas small company stocks, meaning small cap stocks with say under $1 billion of market capitalization, they get higher rates of return, but they also have a pretty high risk of failing. Large company stocks like your Procter and Gamble, your AT&T are less likely to fail because they can, if they do face financial trouble, they can borrow at really cheap rates. But on the other hand, the rates of return are lower. The only time we get into trouble are what we call black swan events. We used to be able to say that black swan events don't happen maybe once in an investor's lifetime. We've already had two. um, we had the 2008 financial crisis as a black swan event, which widely impacted the entire economy. And it's largely why we call it not just a housing crisis, but a financial crisis. But we also had it with the pandemic, of which these slides didn't really reflect that. So that was also a black swan event. It had a large impact on the economy as a whole. Then we've got liquidity. How quickly do you need your money to be cash? And this would um, the faster you need cash, you'd want the market to be rather broad, and additionally, you would want the market. You'd want the market to have enough buyers and sellers so that you could sell it quickly with a relatively stable value, which is why we usually are saying that if you have a high need for liquidity, you're probably going to be in bonds. So, for instance, insurance companies have a great deal of need for liquidity because they have to make payments to individuals, right, for claims, death, destruction of personal property. And so they need liquidity to be able to provide that cash and provide that payout in a timely basis. So states that regulate the insurance industry typically require a fairly large amount of liquidity with those institutions holding bonds. Same for banks. Banks have a need for liquidity. If depositors come and they can't get their deposits, then the bank will fail. And so, um, yeah, they are then stuck in bonds. And so you see this kind of then discussion here. Is that in general, when you see um, wealth increasing, that generally we would see both stock and bond investing increasing. That when the expected return on a certain asset is increasing, that certain asset that has the higher expected return, more people will invest in it. The greater the risk, most of the time, that people won't invest in that stock as much. But there are exceptions. The one notable exception, I'm not trying to be political here, but the one that investors have had a hard time understanding is, Donald Trump created that. Um, it's called Truth Social, which is supposed to be kind of like a Twitter replacement that he controls, and they created a company, uh, and that company now has a ticker symbol. The company itself didn't take in much revenue, and it seems to reflect, kind of the personal popularity of Donald Trump. So if I, as an investor, not a politician or even someone interested in politics, of which I'm not interested in politics, but if I were to look at that as an investor, again, just as an investor, not as someone who likes or dislikes the guy, that's a pretty risky investment in that stock because there's a great deal of variability. And yet the variability has increased in the past week or two, and yet the price of the stock has gone up. So it's a little bit weird. It's a bit hard to make sense of, which then even makes me steer farther away from it because now I have to question whether the price of that equity actually reflects the true value. The greater the liquidity, the more people would generally want to invest in that thing. And the um, higher it costs to get information about the product, fewer people would want to invest that time to get that information. That in general, when we're talking about individuals investing, we're generally talking about them. We're generally talking about them needing some fair amount of diversification, spreading their risk out over different asset categories, which again goes back to our 60-40 mix. That an individual with their total wealth puts 60% of their wealth in stock, 40% in bonds, that they would generally speaking get a pretty diverse, stable set of returns. That 60-40 mix not only gives you diversification, but it reduces your market risk, right? Because now you've got bonds that are more safe than stocks. And so if we're in a bad time, stock prices will go down, but bond prices will go up, right? So you've got some good balancing there. And then also, right, mutual funds do this as well. Mutual funds give you that diversification. Those target date funds can give you that market risk reduction. The only things that are a little bit more difficult is this idiosyncratic risk. It's not hard to do it, but the problem comes down to, let me give you an example of the idiosyncratic risk. Let's say I worked for a company that issued stock. Let's say that I worked for Southwest Airlines. Okay, so I can buy the stock, LUV, love, and I work for the company. So you'd be like, why shouldn't I invest in that stock? Because I know the company well. I work for it. So if things are starting to go bad, I'll probably be the first to know because I work there. If things are slowing down, I'll know first. But the problem, right, is that you're now in one industry, the airlines. And in the case of Southwest, it's even largely a domestic airline. And you work for the place that also contains all of your wealth. So do you see there how you've really kind of mashed all of your wealth into one thing? You've got no diversification. You've got a lot of market risk, and you've got idiosyncratic risk that you're all in one particular asset. Which is why any financial advisor would tell you, don't invest in the stock for the company that you work for. Okay, I'm just going to skip this apply the concept just because I don't want to run behind here. You should look at this slide, though. I mean, it is in general here pretty accurate that in terms of like how people should create a financial portfolio. That a lot of it does really depend on your age. Age is probably the largest determinant of things. Okay, so now let's look at the bond market, which is actually doing the determination of the interest rates. So we looked at in the last chapter this idea of the bond price and the way that it was linked to the face value and the point at which it was maturing. If we want to look at how that interest rate is being determined, there would be two ways that we could look at it. We could look at it from the bond market approach, or we could look at it from the market for loanable funds approach. Let's look at both here. So in the bond market approach, we're basically treating the bond like something that you would buy, like food or clothing or gas. So, right, it's just simple demand and supply. People demanding bonds, supplying bonds, and how that affects the interest rate. As an example of this, when we want to think of like stresses on the bond market, I'm not rich, but I have rich friends. And this really old guy I know, he's got like a lot of money. Like, I don't know. If I had to guess, my kids would probably be the one that would ask me these kinds of questions. If I had to guess, I would say he probably has. I've found that rich people usually tell you how much money they have. But if I had to guess, I would say he probably has $25 million, $30 million. The problem that he faced in 2022, as he told me, was that not a lot of bonds out there, and that there were lots of buyers. So what would that suggest to you, right? Is that the interest rate was really low. So the interest rate's being determined here, quantity of bonds purchased here on the. Sorry about that. My computer stopped recording here. So I'm not exactly sure where it stopped recording. So I've got the graph here still drawn here, but in our discussion here, what I was talking, and so I'm probably repeating a little bit of what was just said, but in 2022, we had among individuals and businesses, not the government, but just individuals and businesses, we had not a lot of bonds being issued because corporations had a lot of money based on subsidies they were getting from the government because of the pandemic. So not a lot of bonds are being issued, but lots of people wanted to buy bonds because they were scared shitless and they didn't know, and they had a lot of cash because of the subsidies they were also getting from the government. And so if we had just let the situation exist as it would have been, then interest rates should have been high based on this bond market approach. But they weren't. They were really low. Why is that? Because what happens here is that the Federal Reserve, one of the largest players in the bond market, because it buys and sells existing debt, it can impact then the demand and the supply here in the bond market and shift it to where they want that target rate to be. The thing about the bond market approach is that there's not a lot of very large players in this bond market. And so that becomes a bit useful because what it means is that you can then pretty easily coordinate activities. If we look here domestically, you've got Vanguard, which is the company we looked at here previously, a very large holder of bonds. But also a very large holder of bonds is Berkshire Hathaway, run by Warren Buffett. He owns insurance companies like Geico, but also he just holds the bonds as an investment. And so, so if the Federal Reserve wants to make sure that bonds get bought or that the market doesn't get flooded with a lot of people selling things, they probably will coordinate their activities to some extent with Vanguard, with Berkshire Hathaway, and whatnot. I forgot the article. I had read an article about it. I think it was in the Wall Street Journal. That was just talking about how much influence Berkshire has over bonds. I can't find it very quickly, so I'm not going to go through all this here. Okay. Okay. Well, a lot of wealth there in Berkshire Hathaway. Oh, there we go. Here. Oh, that's from 2001. Okay, well, it's not that old. I didn't read the article that long ago, or at least I wouldn't have remembered it. Okay, so that's our bond market approach here, which again we're going to get to right here. And then we have our loanable funds approach. This would be where we look at the money itself as the good rather than the physical bond as the good. And so here in the loanable funds approach, we're just trying to talk about this idea of the general preferences for that money. So let's just look at our picture here, right? No surprise here. This is pretty straightforward. You've got supply of bonds from businesses, supply of bonds from the government, and then you have demand for bonds. Demand for bond that comes from, businesses buy bonds, but also individual retail investors buy bonds. And then also additionally, it should be noted that we also have governments buying bonds. The Chinese, for instance, are very large buyers of U.S. bonds. The British are very large buyers of U.S. bonds. The Canadians also buy our bonds. So the Japanese really love our bonds as well. China and Japan together are among our largest international buyers of our bonds. And there you go, right? We would look at equilibrium, and we would see that there'd be changes to the interest rate based on whether we had a excess supply or excess demand for bonds, which would cause upward and downward pressure on the interest rates and get us to our equilibrium. Nothing interesting there. This is just kind of simple supply and demand discussion. What's all going into that demand for bonds? Well, we just looked at these, right? I've been talking about them here. This would be the wealth of the individuals, the expected return, the risk, the liquidity, the information costs. All of these things are going to cause people to choose bonds over stocks. And then we can see that as different events change, the demand will shift, right? So the pandemic, if we go back to here, the pandemic did cause individuals to try to risk off, meaning reduce their overall risk in their overall portfolio and want to buy more bonds. It also created a situation where they could see the volatility of the stock market and they could say to themselves, what if I need my cash right away? What if I get COVID and I need some lengthy care? I can't just hold this anymore because I don't know if I'm going to get the cash I need. I'm going to go into bonds. Yeah. Then let's just go in here. I don't want to keep repeating what I've already said here. So you've got the slides in front of you here. You can kind of see these, but sorry, I'm skipping over this just because the lecture does get really long if I end up repeating myself. So this should be, I'm hoping, straightforward, but also I've kind of mentioned these things here. Now, we haven't talked much about the supply of bonds. We talked a little bit about it, but not in any great detail. The why a company decides to issue a bond, why a company decides to issue a bond will depend on what they expect. I think some of the biggest things would be what they expect future profitability to be for, borrowing this money and what they're going to put it into. What are they expecting to get out of it, right? If I'm saying to, someone, I want to, for instance, Tesla, right? Elon Musk. So if Elon Musk wants to borrow money because he wants to expand his rocket operations, which in his series of businesses is one of his most profitable lines of business, he'd probably want to borrow money for the rocket side of the business because the pre-tax profitability of those investments in rockets is pretty high. On the other hand, right, he's got a series of businesses. The other one would be he builds solar panels and batteries for solar panels. Well, the solar industry, the profitability there has gone down quite a bit this past year. So again, right, if he's borrowing money for that purpose, we might want to second guess that. Obviously, we'd also then, because this is pre-tax profitability, we'd want to think about the future tax liability that I would face. What's the future inflation rate going to be? If I think that the future inflation rate is going to be high, then I'll borrow money because it's going to be easier to pay back that borrowing. And then businesses compete with the government for money that's being saved. And it's difficult for companies to compete with the government. So you don't want to be borrowing lots of money at the same time that the government's borrowing lots of money. Because the government borrowing money tends to soak up all the loanable funds out there. And so it'll make it more expensive for me to borrow. So to review here, to the extent that pre-tax profitability of physical capital investment is higher, then I will supply more bonds. I'll issue more bonds. To the extent that I think business taxes will be lower, I will issue more bonds. To the extent that expected inflation is higher, then I think it's going to be higher. I will issue more bonds. And to the extent that government borrowing is higher, I'll issue fewer bonds. So I guess we'd say if government borrowing is lower, I'll issue more bonds. And so that's what we kind of start to then see here, right? Is that with those factors in the supply curve of bond supply shifts as these factors adjust. Again, here's our the business taxes. Now, when I was talking about expected inflation, I was talking about unanticipated inflation. If we wanted, meaning surprise inflation. So I can make guesses about what I think inflation is, and I can think, and I do oftentimes think, that the market's getting it wrong and that the interest rate is going to be higher or lower. If you remember my conversation point earlier, when I bought my house, I was expecting inflation to be much higher than it currently was. And so I bought that house based on the idea that the real interest rate was going to be lower. And then again, you've got your government borrowing. Again, when the government needs to borrow money, we regular borrowers tend to find it more difficult to get funding. And so again, you get this kind of description here. Business taxes go up, supply goes down. Okay, so that was our bond market approach to understanding these things. That bond market approach can then help us try to understand the interest rate as a whole, because we can look at this. We can look at how interest rate changes over the business cycle. That in general, what we would tend to see is that let's not try to predict things here. Sorry. At the same time, there was the TV on at the same time. That what we would see, that in general, that when the economy doesn't do well, that it tends to, people feel less wealthy, and thus they don't buy bonds as much. And what this also causes is that if the economy is not doing well, that businesses then expect that they're not going to make a lot of money in the future, that their profitability is going to be down. And as a result of both demand decreasing and supply decreasing, is it really actually depends on how much they're changing by. But in this situation, where I had supply shifting by more than demand, here they showed that the bond prices were rising, which is typically what we tend to see. Is that bond prices typically do go up when the economy doesn't do as well. And that in general, what we tend to see here is that as expected inflation goes up, that we tend to see that bond prices fall. Now, let's just keep this in mind here. We have to do vice versa here, right? Prices of bonds and the interest rates are inverse. So if the bond price is going down, the interest rate's going up. And so, again, when these lectures were made here and they were trying to understand at that point in 2020, 2021, why were interest rates so low? Well, in some part, it was reflecting the fact that we had just come out of a recession in early 2020, but it was also reflecting the fact that um, bond prices were falling as people were starting to see higher and higher inflation starting in late 2020, early 2021, well, throughout all of 2021. And then it caused existing bond prices to fall. And you get to a situation where people almost, in some sense, based on this discussion where the bond interest rates are so low, you almost give up on investing in these kinds of bonds because you're just not going to make any money in this space. Going back to our bond market discussion, though, essentially what we saw was that, yes, both supply and demand shifted, but demand shifted more. And because demand shifted more than supply, bond prices went up. And again, inverse directions here. Bond prices went up, interest rates went down. Um, people, what's behind that demand going up? Well, you've got two factors here, and that's kind of described right here. You had people buying bonds, but people buying more bonds because they were trying to take risk off. But the bigger thing was the Federal Reserve buying lots of bonds in an attempt to keep interest rates low so that the economy was properly stimulated. This whole discussion here, where you finance government spending by issuing bonds that the Federal Reserve is going to buy, this is all part of MMT, modern monetary theory. This is a really cool theory. We don't talk about it in the principles class because this theory really only strongly emerges in the late 2000s. And if you find this kind of theory interesting, the modern monetary theory approach, um, University of Missouri, Kansas City is kind of where a great deal of this kind of research is being done. And actually, Dr. McConnell, now dean of the business school, um, came from there and would be kind of one of the proponents, I would tend to suspect, of this kind of approach, as opposed to a Keynesian approach, as opposed to a monetarist approach. Someone who believes in MMT, modern monetary theory, would believe that we can do some of the Keynesian things we want to do in a recession, like dramatically increase government spending by issuing these bonds to keeping interest rates low, which then also further stimulates the economy. But what's the thing that we saw in 2022? Inflation. And then eventually the interest rates actually have to go up to kind of try to control that inflation. So even modern monetary theory is having to kind of undergo some deeper thought about, where to kind of go from here. Okay. I'm just trying to make this a super long lecture. So what about the loanable funds model, basically, or our money market model? Um, so here, instead of looking at the bond market approach and the money market approach, um, we're looking at the money itself, not people buying bonds as a product, but rather people wanting money in general or supplying money in general. That this is called the liquidity preference model. And in this approach, why do people need liquidity? Right, would be the question. That your need for liquidity is determined kind of like where you are in your life cycle and whatnot, what your immediate needs are for cash. But that the interest rate that's presented to you is what the cost is to holding money. If you don't have a lot of need for cash, then why would you want to hold money? That interest rate would be pretty high if you don't have a lot of need for money. On the other hand, if you desperately need the cash because you're not working and you need this flow of money coming in, then that interest rate is less important to you. So, thinking of it that way, what's their demand for liquidity, their demand for preferences? It's going to depend on where they're at in the life cycle, but we're also then going to shift the curve based on the overall GDP level and the overall price level. The idea here being that as the GDP is higher, that people will need more liquidity because they're going to be buying more stuff. As the real GDP is lower, the economy is slowing down. People don't need as much cash because they're not buying as much. On the other hand, if the price level is going up, people have a lot more demand for liquidity because they just need more cash to just do these normal transactions. On the other hand, when the price level is going down, they don't need as much cash because, right, things don't cost as much. And that's kind of what we see here. Increase in real GDP, increase in price level is going to shift out my demand for liquidity. Decrease in GDP, decrease in price level is going to reduce my need for liquidity. And then the money supply is going to be vertical. Why is it vertical? Because it's determined by the Federal Reserve. The Federal Reserve controls the amount of money that exists. And so then the only things here would be the Federal Reserve telling you how they're going to adjust the money supply, either increase it or decrease it. And then people could shift out their demand. But here, what we're seeing here is that if only the supply of money is increasing, that what we saw essentially in 2020 was not a lot of changes in the price level, not even a lot of changes in the real GDP. Really, what we saw is an increase in the money supply, which caused a movement along the demand for money, thus the decrease in the interest rate that we saw. So do you see there? We've got two now explanations for why we saw lower interest rates in 2020. One was the supply and demand in the bond market in general. And then here, we could just look at the money market in general and how people, whether they needed liquidity or not. And that's what we see right here. Okay, now going on and looking at this from an international perspective, like how are things affected in the international capital market? Well, we obviously in the United States compete against other countries when our government issues bonds and whatnot. And so that would mean that the interest rate for our government bonds is going to be different than other governments have for their bonds. It's all going to be determined by what the interest rate is or what the riskiness is of those other countries that are borrowing the money. So here we see this demand and supply, typically shaped here from we can see it from both the bond market approach and the loanable funds approach, this kind of similar discussion here. And obviously, we can see that people would buy more bonds from a certain country if that country was posing less risk. So it is true that during COVID, people were buying lots and lots of US bonds because our country was deemed the safest in the world. And our country was also issuing lots of bonds because we were, um, uh, providing a lot of subsidies to both individuals and to businesses. But the loanable funds market, when we talk about international markets, doesn't look that different. This picture doesn't look that different here. So you've got your money market approach, your loanable funds approach, which helps us look at things internationally, and our theory for liquidity preferences, all reinforcing one another about why the interest rates were so low. We could start to have a discussion here of how is a open economy different than a closed economy in terms of how you set this up, but we don't really have closed economies. So, in terms of this discussion here, slides 62 through 63, I wouldn't worry about it. It's just theoretical. Let's just jump ahead here to large open economies, which is what we have here in the United States. We are a large open economy, which means that our bonds compete with other bonds, but we're so big in the market that we can kind of dictate a difference between our interest rate that we're charging and the rest of the world. In some sense, we almost can set the rest of the world's interest rate. And that's kind of what you get as a discussion here, which looks a little bit different, but it does make sense, is that we are able to, in the United States, have an interest rate that's lower than the rest of the world because we are so large, and yet, so we can, right, we lend out this excess supply. We are issuing more bonds than people are buying domestically. So people outside of the United States are buying $50 billion of our bonds, which takes away from the rest of the world, though. So what you see here is that we kind of can lower the rest of the world's interest rates because now other countries have to compete for that same $50 billion that now they're buying in US bonds. And in essence, what it can do here for the rest of the world is cause interest rates to be a little bit higher because now they have to compete against the rest of the they have to compete against the United States. So when we try to look at this of what happened in the early 2000s, what we can see something a little bit different here, but essentially the rest of the world was saving a lot of money, buying a lot of bonds, made interest rates lower in the United States than the rest of the world. And that perhaps one way you could see this is that they were so low that people were buying way too many houses because interest rates were too low. I think that's blaming others for our problems. It's not Ben Bernanke's fault. It's not people from outside the United States' fault. It's, if you want to ask me, Scheiding, what I think, it's a little bit more Alan Greenspan's fault. Alan Greenspan just liked nothing more than artificially low interest rates, if you're asking me. But I don't think you're going to get that from these authors of this textbook. Okay.